Warren Buffett, multi-time billionaire and probably the best investor of the world, says that The Intelligent Investor by Benjamin Graham is by far the best book on investing ever written. In the book, there are 3 models every serious investor has to know. First, it is important to know the difference between investing and speculating. Imagine, you want to buy a farm. Then you would first inform yourself about the current prices of crops and how much income the farm earns with it, and the cost of running the farm, how much you have to pay for personnel, seeds and fodder. You would want to know how much land and how many animals the farm has, and in what conditions the machines are. Then you would value each item separately. Literally, you would want to know the value of the land, how much the animals are worth, and the remaining value of the used machinery and house. Based on your calculations, you would negotiate a price which would give you a decent return. When you think like that, then you are an investor. But if you don't care about the underlying value of the assets and the long-term earnings of the farm, and you are willing to pay a price far beyond any reasonable valuation because you are just interested in buying the farm, literally hoping to find an idiot who will pay an even higher price, then you are probably a speculator. This is fine, but it's very important that you know the difference. There's intelligent speculation as there's intelligent investing, but almost always speculation is unintelligent. Speculating is especially dangerous when you think you are investing and when you are risking more money in speculation than you can afford to lose. Actually, it's the fastest road to go bankrupt and to live a miserable life with everyday financial worries. We all know the advertisements of day traders who are spending the whole day in front of their screens, trading currencies, shares and commodities within seconds. But this has absolutely nothing to do with Buffett's investing approach and building a fortune over time. The second concept deals with the margin of safety. This concept can originally be found in engineering. Imagine, engineers building a bridge that must support 7 tons of traffic. Would the bridge be built to handle exactly 7 tons? Probably not. It would be much more prudent to build a bridge to handle, say, 10 tons to ensure that the bridge will not collapse under heavy load. This gives you a margin of safety of 3 tons. The same can be done with securities. If you feel that a stock is worth $10, buying it at $7.50 would give you a margin of safety in case your analysis turns out to be incorrect and the stock is really only worth $9. Let's have a look at our previous example of the farm. As an investor, you would want to look at the assets, liabilities and future earnings. From this, you would come up with a fair value of around about $1 million. But as a value investor, you won't pay $1 million. You would only be willing to pay $700,000 because you could have made mistakes in your calculations. That leaves you with a margin of safety of $300,000. And please guys, don't ignore this rule. Don't think you are so smart. Even Warren Buffett is aware that he will make mistakes. But it is important to know that no sure formula exists to determine how wide the margin of safety should be. You have to come up with your own methodology. The third concept is known as Mr. Market. Imagine, you have a private business, doesn't matter if it's a local bakery or Fortune 500 company. You own 50% and your accommodating fellow and business partner named Mr. Market owns the other 50%. Every day, Mr. Market comes to your office and names a price at which he will either buy your interest or sell you his. Even though the business that the two of you own may have a stable underlying value, Mr. Market's prices will be different every day. For sad to say, the poor fellow has incurable emotional problems. At times, he feels euphoric and can see only the favorable factors affecting the business. When in that mood, he names a very high price because he fears that you will snap up his interest and rob him of imminent gains. At other times, he's depressed and can see nothing but trouble ahead for both the business and the world. On these occasions, he will name a very low price since he is terrified that you will unload your interest on him. Mr. Market has another endearing characteristic. He doesn't mind being ignored. If his quotation is uninteresting to you today, he will be back with a new one tomorrow. But it is very important not to forget that Mr. Market is there to serve you, not to guide you. If he shows up someday in a particularly foolish mood, you are free to either ignore him or to take advantage of him. But it will be disastrous if you fall under his influence. Think about it, guys. The only market where people run out screaming when the prices drop significantly is the stock market. Everywhere else, people welcome discounts and are happy to stock up with cheap groceries, electronic items or clothes. The same behavior should be applied in the stock market, so the next time when the market drops, keep the concept of Mr. Market in mind and collect the bargains. Well, these were the 3 most important concepts from the book The Intelligent Investor by Benjamin Graham, animated by Financity. If you liked the video and you want to discover more financial concepts that will increase your investing success, subscribe to our YouTube channel.